Why do you have differences between GAAP accounting and tax accounting? Well, we have differences based upon the rules and regulations behind each basis of accounting. So we're going to go through 5 examples where you will definitely encounter book to tax differences, meaning you have a difference between the GAAP accounting and the tax accounting. All right, let's go. Example number 1, unrealized gains and losses related to trading securities. And if you're not familiar with trading securities, GAAP basis accounting, these are stocks and bonds that you are not anticipating holding for a long period of time. So you're going to mark your unrealized gains and losses and reflect those in your income statement and ultimately in your earnings. In this instance, we're going to recognize $18,000 of gains related to our trading securities portfolio. You'll notice our net income from a GAAP basis went up by $18,000. Tax, we're literally going to do nothing because from a tax standpoint, you are not recognizing a gain or loss until you sell that security. So if we're still holding those stocks at the time of reporting and they have an unrealized gain or loss, from a tax standpoint, we are just going to ignore. We're not going to recognize anything until one of those securities or all of those securities are sold. From a GAAP to tax standpoint here, my net income on a GAAP basis, $318,000. My net income from a tax basis, $300,000. Example number 2, Keyman life insurance policies. Keyman Life, if you're not familiar with this, it's a life insurance policy for executives where if they were to unfortunately pass, it would have a detrimental impact to the business. So a lot of times businesses will buy these Keyman life insurance policies just to hedge anything happening to a key executive. But from here, we're going to look at it from an expense standpoint. When we pay that Keyman life insurance policy, why do we have a GAAP to tax difference? So on a GAAP basis, it's just going to look like a normal expense. You're just going to deduct it. Now, on a tax basis, life insurance policies are not deductible. So you're going to have this permanent difference between your tax accounting and your GAAP accounting on these Keyman life insurance or any sort of life insurance policies. And you'll notice on our GAAP basis of accounting, we have $100,000 of net income. And on our tax basis of accounting, since we cannot deduct the life insurance policy in this example, we end up with taxable income of $125,000. So in that situation, we're going to pay a little bit more tax than we initially thought on a GAAP basis because we can't deduct our life insurance policy. If you've gotten some value out of this video so far, please punch that like button and consider subscribing because I'd love to get YouTube to push this video out further so other people can get a better understanding of these book to tax differences. All right, let's continue. Example number 3, depreciation and amortization. All right, let's go over fixed assets first. We have a server, we have a truck, we have some furniture on our books and records. And we're going to have an accounting or fixed asset accounting policy that's going to give us some guidelines on what the useful life or useful lives should be of these assets. And then we're going to take that, and we're going to take our cost basis, what we paid for those assets, and we're going to straight line depreciate those assets over their useful life. Based upon the straight line depreciation, we are going to recognize our annual depreciation related to those fixed assets. Intangible assets. Let's take a hard look at this because it's going to be a little different than fixed assets. You might not have an intangible asset policy, much like you would have a fixed asset policy. These are going to be more looked at when you buy the intangible or create the intangible and how long that useful life is. In this example, we have a book of business that we bought from another business. We have customers that we've brought in-house. And in this example, this book of business, we determined that its value or what we purchased it for was $500,000. The useful life related to an intangible asset going to be a little bit more subjective. You're going to look at your past experience with buying intangibles or creating intangibles. You're going to look at market data and just what it is. Do you think it's going to last X amount of years? In our example, we think our customer book of business is going to last 20 years. So in this instance, we're going to take our cost, our purchase of the book of business, and it's going to be a straight line amortization. We're going to take our $500,000 cost basis, divide it by 20, and and we're going to recognize $25,000 of amortization each year. So let's layer that into our GAAP financial. Now, switching over to tax, you're going to run into a very different scenario. In this example, we're going to assume the fixed assets that we have purchased are eligible for Section 179. And Section 179, if you're not familiar with that, that gives you the ability from a tax basis to take the full cost or the expense of that fixed asset in the year that you purchased it. Unlike the GAAP basis accounting, where you are taking a straight line depreciation approach, taking an asset, and let's say the server in this example, $25,000 cost divided by a useful life of 5 years, you have depreciation of $5,000 per year for that asset. Section 179, we're going to take the full expense related to those fixed assets, as long as it's eligible for Section 179 in the year that we purchased. Now, amortization related to an intangible asset have a certain set of rules. If you're buying a book of business like we are in this scenario, you do not get to choose your useful life. It is 15 years. That has been provided by the IRS. So that $500,000, even if I think it's going to last 20 years or 30 years, the IRS says, hey, it's a 15-year asset. Take your $500,000 book of business that you bought, divide it by 15. That is your expense each year for that book of business. So let's layer that in. So you'll say we have a pretty large difference between our GAAP basis financials and our tax basis financials. Net income on a GAAP basis, $256,250. On a tax basis, especially since we can take that Section 179, we're ending up with taxable income of $184,167. So you can see from a GAAP to tax standpoint, depreciation and amortization can have major differences between the two sets of accounting methodologies. Example number 4, stock options. And specifically, we're going to talk about non-qualified stock options in this example. You're going to have GAAP to tax differences. And let's see why. I want to show you a year 1 when the stock option was issued, and I want to show you year 3 when the stock option was exercised, so you can see the difference between the accounting from a GAAP to tax standpoint. So from a GAAP standpoint for stock options, we're gonna look to ASC 718-10-35-2, and stock option expense can be fairly complicated. A lot of times you're going to have software that does the calculation for you. But basically, you want to find what the fair market value of that option is when it's been issued. And you want to take the that fair market value times the number of options that have been granted. And you're going to straight line amortize the stock options over typically your vesting period. So in this example, we have a 3-year vesting period. Our fair market value of the options that were issued is going to be $15 times 10,000 shares. We have $150,000 of options that have been granted that we need to amortize over the vesting period of time. And with the vesting period of time being 3 years, it's going to be $50,000 a year of expense. So I'm going to take the $150,000 value, divide it by 3. I have my stock option expense from a GAAP standpoint of $50,000. Now, from a tax standpoint, year 1, literally going to do nothing. Just because the stock option has been granted, from a tax standpoint, that does nothing. The person receiving them doesn't have a taxable event. The company granting them, it doesn't have a taxable event either. There's no tax consequence until the person who received the stock option actually exercises. All right, let's jump down to year 3 because we're going to have a little bit different of a scenario based upon the person who has received these stock options exercising those options. So we still have the $15 fair market value of the option that was determined when the business granted those options, but the stock price has gone up to $45, and we have a strike price of $25. So there's a $20 spread. So there is a gain or a built-in gain on these options right now. And we're assuming the person that received these stock options has exercised all 10,000 of those options. So let's see what happens from a GAAP and tax standpoint in year 3 based upon somebody exercising these 10,000 stock options in this scenario. So from a GAAP standpoint, we're par for the course. We're just going to take our $50,000 of amortization that we talked about. We have our value of the options when they're issued, and we're recognizing that expense over the vesting period. Now, from a tax standpoint, we have a taxable event. That person has exercised their options. And from a tax standpoint, you can deduct the stock price less the strike price. In this instance, is $20 times 10,000 options. You can deduct that because that is going to be stock option expense from a tax standpoint. And on the flip side, the person that's exercising those options is going to be taxed on that as well. So in this scenario, from a tax standpoint, we're going to take our stock price of $45, our strike price of $25, and we're going to multiply the difference, the delta between the stock and the strike price, times 10,000 options. That's the taxable income to the person exercising. This is the stock option expense from a tax standpoint for the business. So you can see there's a large difference on when somebody exercises their options from a tax and GAAP standpoint. If you look at the net income on a GAAP basis, year 3, $250,000. On a tax basis, my net income is $100,000. There is a big difference based upon the methodology of how you recognize stock options and stock option expense. And our last example is going to be meals and entertainment, specifically client meals and client entertainment, because there are some different roles if you entertain clients versus employees. So we're going to focus on clients in this scenario. So GAAP to tax difference, from a GAAP standpoint, you're just going to take the expense. And I'm going to end up with $335,000 of net income. Tax, not as nice. From a client business meal standpoint, you could only take 50% of the cost and deduct that. Entertainment, you get a whopping 0. A lot of client entertainment is not deductible from a tax standpoint. So if you take a client to a concert or to a baseball or football game, soccer game, or whatever, not deductible from a tax basis. So if you look at our net income between GAAP and tax, you'll see we have a difference. GAAP, $335,000. Taxable income, tax net income, $362,500. It's higher because you're not getting the full deduction of those client entertainment and those client meals. Okay, let's put this whole thing together. I've got a P&L that's going to be on a GAAP basis. I'm going to have a P&L that's going to be on a tax basis. Let's layer in all 5 pieces that we just went over, and let's see how different those results look. So let's get our unrealized gains from our first example. For tax basis, remember, it's 0. You don't recognize unrealized gain. You only recognize a realized gain if you sell something. And then I forgot. I want to highlight these so I know I need to fill them in. All right, so then key man life insurance. For GAAP standpoint, I got my expense. From a tax standpoint, I'm getting nada. Can't deduct it. Meals and entertainment. So GAAP, get my full 25. Entertainment, get my full 15. Tax, getting half of my client meals, and I'm getting nothing for client entertainment. Stock option expense, we're going to assume year 3 in this example. Stock options, I got $50,000. We're amortizing the fair market value of these stock options when they're issued over their vesting period. And for tax basis, we're recognizing the option being exercised and the spread between the strike and the fair market value of the stock price, which is taxable to the person exercising the options, but is a deduction from a tax basis for the company. All right, so now let's layer in depreciation. So we got straight line across the board for our fixed assets and our intangible assets from a GAAP standpoint. From a tax standpoint, we're going to take the Section 179. We're going to take the full expense in the year we bought those assets, as long as it qualifies. And we're only going to be able to amortize our book of business over 15 years instead of 20 that we're doing for a GAAP basis. So look at this. From a net income standpoint, from a GAAP basis, with the same transactions, we have net income of $159,250. From a tax standpoint, same transactions, just different basis of accounting, you have a loss of $28,333. This is how book to tax differences these different methodologies of accounting can have a wild difference on your results. And that's why you have book earnings and you have tax earnings. They're not going to be the same. As you could see in this scenario, we had 5 examples and they had wildly different results to our net income and our taxable income based upon the methodologies. So that is book to tax differences. I hope you learned something. I hope you got something out of this. And I hope you have a good rest of the day. Take care, and I'll see you in the next video. Goodbye.